Hi, and welcome to our end of July update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just a couple of adjustments each year to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in the book are easy to calculate and adjust each month, for those of you who are new to concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So in this month, we'll continue with the Busy Doctor's update of the month, the topic of the month, then we'll go over our systems, including the 20-month moving average system, the MRI system, or the monthly rotation investment system, review the rules for the 25% stop loss system, and monitor the free sector surfer strategy for those of you who have your own sector surfer strategies and would like to see how I monitor a sample strategy. So, day in the life of a busy doctor. Now, ever since I retired 4 years ago, life still has been busy. Now that I found this new calling to help people out with investing, despite needing me more and more at the University Hospital because we're still short-staffed chief of nuclear medicine, building a new business from scratch is still a lot of hard work. So despite all this busyness, I still easily place the trades intended by my systems. They literally require mere minutes to see and execute. So a story about last month. I was on rotation, and the techs were there, the residents were there, the medical students were there, and they noticed that I wasn't on schedule for next week. And they were probably disappointed. So they asked me, well, wherever you're going, I hope you're having fun. And I nodded and said, yeah. And so they asked me, so where are you going? Going to seminar. Of course, the techs, their faces were like, gee, that's no fun. But, I pointed out that seminars is where we keep up with our learning and continuous learning. So they begrudgingly said, okay, well, so which meeting am I going to? And I said, well, I'm actually going to a business seminar. And then they go, oh, you're working on that business again. So that's what I did. I went to a business seminar, and that's where I actually met the author of this book, who is pretty amazing. So when I met her in real life, I noticed that she was a patient with a known advanced neurodegenerative disease. You can read the book to see exactly what it was, but for decades, she pretty much exhausts the limits of medical science. She's been poked and prodded by neurologists and neurosurgeons and hand surgeons and rehab. She's had multiple surgeries. And of course, someone with a debilitating disease that keeps on degenerating, the normal response, you wouldn't blame them if they got depressed and despondent. However, she documents in her book the inspiring story of how she transitioned from this debilitating stress and agony to a life of functional joy and bliss. Now, for the non-doctors out there, just to let you understand that from a medical standpoint, just to have stories of documented nerve regeneration or recovering function of some of these degenerative diseases is almost unheard of. So this is amazing. It's like holding a ball, and when you open it, instead of the ball falling, it rises up. So I got to talk to her, and she truly embodies the mantra, it's not what you have, it's what you do with what you have. I've said this before in my book, I've said this before in my videos, and she's an embodiment of it. So overall, very interesting reading, I recommend it. So now the topic of the month, Bitcoin. So many people have asked me over the last couple of months, should I buy Bitcoin? What's my view on Bitcoin? And just a caveat, I'm not an expert in Bitcoin. I do not own Bitcoin. The following discussion does not imply any recommendation at all. And from my point of view, to approach the topic of Bitcoin, I like to look at least two different aspects. One, the technical aspect, their charts, in other words, and then look at the underlying reason why to own Bitcoin or how to use Bitcoin to begin with. So here's a chart of Bitcoin. Bitcoin's been around for around a decade, and lately it's been so popular that several different free websites have been carrying publicly available data dating to at least 2015. And we take a look at this graph, you'll notice that it's parabolic, which you might find familiar. For instance, here's another familiar graph to many of us who lived through this nightmare. Back in 2000, we had the dot-com bubble, and here's another parabola. So these parabolas, to me, they're not sustained by any underlying fundamental reason why these prices should go up as fast as they do, and they often signal a bubble, and bubbles often pop. And I'll show you two main characteristics of these particular bubbles. So I went over two additional examples of stocks that went bubble in my book. So in chapter 7, I went over this example of how there was a medical device stock that a lot of my colleagues bought at around this level, and I heard about it when it basically doubled in price. I got in knowing that it's a parabolic curve, but I had an exit strategy. So I bought here, and I got stopped out here. And the details are in my book. But for those who hung on until the bitter end, they lost a lot, despite the parabolic curve. And here's another example of another stock. This one I got from a newsletter. It wasn't a parabola at the time I bought, but as it started to rise, I bought, and bought, until finally I got stopped out. Again, details in my book. And lucky I did, because boom, this stock crashed later on as well. So here's a parabola here, here's a parabola here. So just to update on these two stocks, this medical devices stock, yes, it crashed, but then yes, it did eventually break even and even increased in value even more. But look at how long it took for it to recover. Meanwhile, this second stock, the one from newsletter, it eventually got delisted from New York Stock Exchange. It became a penny stock. You can see by the prices here. So yes, it jagged up and down, and then it did eventually climb up again, but then it crashed again. And had you kept holding on to this particular stock, you'd still be down. So throughout history, there are other examples of bubbles. The tulip mania of 1637. This was when 1634 tulips were first introduced to the Dutch, and it got very popular. In fact, it got so popular people who weren't even interested in flowers started buying them because they were worth so much. In fact, a single bulb was worth more than a house. And then, of course, that bubble popped. The South Sea Company bubble of 1720, for those of you who study finances and investing in general, this is like the classic example of a bubble. The Great Stock Market Crash of 1929. The gold crash of 1980 started out as a bubble. The Beanie Babies of 1999. It doesn't have to be stocks, doesn't have to be anything so-called investable. Beanie Babies were a toy, literally kids' toy, that due to very astute market manipulation in my view, some of these toys were going for thousands of dollars. And then, of course, it was put on eBay and no one bought, and it crashed. Dot-com bubble, 2000, you saw the example above. The housing bubble, 2007, which is, for most of us, we've acutely experienced this. Numerous individual stock examples, and of course, you can cite the shoeshine boy effect. And the shoeshine boy effect is, legend has it, Joe Kennedy, in 1929, he was out on the street getting shoeshine, and the shoeshine boy was telling him, gee, buy this stock, it's a no-brainer. And of course, he said thank you, and then when he went back to his office, he called his broker and said, sell everything. Because if everyone, including shoeshine boy, is bullish on stock, chances are you've run out of buyers, and the stocks have nowhere else but to go down. So the underlying question is it a fad, or is it a viable long-term thing? And I'm not going to say a trend or asset or anything, because this could apply for anything. So for instance, let's take a look at two different stock market indexes, the Nikkei and the Nasdaq. So Nikkei famously has crashed back in 1989, had a parabola right here. Similarly with the NASDAQ index, had a parabola right before the dot-com crash of 2000. But with the Nikkei, the Fed never recovers, never in quotes, because yeah, it looks like over the last few years, the market's kind of trying to recover, but it's lost so much that over the last 30 years, it still hasn't recovered. We're talking about generation long. Meanwhile, with the NASDAQ, yes, it did recover, but look, it took around 12 years for it to recover, the lost decade. So that's a long time to be holding on to something when you could be invested elsewhere. I mean, instead of holding on for 70% loss and waiting for it to recover, if you had some kind of system that had you lose less before you got out, and I'm not saying picking tops because that's mathematically impossible, but even if it lost only 25% and you got out, it would have been a lot easier making up 33% to break even than it was to lose 70% and try and break even from there. So again, I have to stress, know your exit strategy and stick to it. So let's go to part 2 of the answer. What is Bitcoin and what can we do with it? Well, number one, Bitcoin is a currency. It's not a stock, it's not a commodity, it's currency. What is a currency? Well, currency is a store of value. It's either backed by some kind of rare, hard to find, reproducible commodity, or it's fiat. In the case of Bitcoin, it's backed by a difficult to hack computer algorithm that lives completely on the internet. It's not backed by any government. It's not backed by any bank. This is a way where you can exchange currency between individuals without going through a bank, no matter how far away you live. And this is the source of a lot of controversy because banks and governments tend to like to control the currency. That's the source of their power. Now, most currencies in the world is fiat. In other words, by fiat decree, by royal decree, by government decree, this dollar or this pound or this whatever is worth something and is legal tender. No one recognizes the value until the government declares its value. And of course, once the value is declared, now the government or whoever has freedom to dilute the value of the currency by printing more. It's very easy to print something compared to commodity currencies where it's difficult to reproduce. So fiat currencies, because it's so easily manipulated, will eventually devalue and collapse. History has shown 100% of the time fiat currencies eventually explode along with the civilization that is supported. But Bitcoin exists only in electronic form, backed by a non-central redundant open source algorithm, making it extremely difficult to dilute. So again, let's step back and take a look at Bitcoin. When fiat currencies collapse, commodity-based currencies still survive. Gold coins survive, silver survives. When at the end of World War II, in places that were devastated like Japan and Germany and even India, you could trade cigarettes and soap for groceries and other goods and services. Back in the Wild West, when we didn't have much of currency in the Wild West, people used bullets. In fact, a shot of whiskey is a glass of whiskey that you could exchange for a bullet, hence the name shot. Most industrial civilizations depend on fiat currency to survive. So, if the fiat currency collapses, it is unlikely the economy that the currency supports will survive. So here's a problem. If our civilization were to collapse, and we're talking the US civilization, we're talking about the known industrialized advanced civilizations, guess what? The power generators will go off. And they're the things that power computers and likely the internet itself. And guess where Bitcoin lives? Online. So if the power goes off, the internet goes off, even though Bitcoin is very hard to hack, Bitcoin disappears as well. So, to summary, know your why. Why are you buying Bitcoins to begin with? Are you actually using it as some kind of currency? One controversy with Bitcoin is that it's been used in the underground. In other words, it's been used for money laundering schemes. Because no banks are able to track it, it can be used to exchange for various nefarious goods and services under the radar. And that was part of the controversy. But more and more legitimate businesses are starting to use Bitcoin. So know your why. Why are you buying Bitcoin to begin with? If you're speculating, know your exit strategies and stick to it. So now let's review our systems. So remember, we have systems because systems objectively look at the footprints of every trader and investor in the markets and let the markets tell us what to do rather than us trying to guess what the markets are going to do. So the first system we're going to look at is the 20-month simple moving average system, otherwise known as a 20 SMA system. So the rules are, if the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So here's the 20-month moving average. For this month, if you take a look at the blue line, which is the S&P 500 Index Mutual Fund, and the red line, which is the moving average, you can see that we are still above the moving average. In fact, the ending price is $228.32. The moving average has increased in price to $201.88, which gives us a 13.1% cushion. In other words, as long as the index goes up, stays the same, or drops up to 13.1% by the end of next month, we're relatively safe. If it drops more than that, we're in danger territory. So the observations is the 20-month moving average continues to signal relatively safe markets. In fact, this particular month, the markets have been extremely bullish since both the index and the moving average has both gone up. Now remember, this system is not designed to catch peaks. Markets must fall enough for a system to fulfill the criteria of danger zone before we get out. So if you're looking for a system that doesn't lose money, this is not for you. However, if you're looking for a system where we can better assess whether or not we're relatively safe or dangerous, this is a good place to start. So of course we can take a look at the Sector Surfer's StormGuard armor, and StormGuard armor is also signaling that it's relatively safe to be in the market. So in this system, we're also still in the S&P 500 index fund. The next system is the monthly rotation investment system, otherwise known as the MRI system. The rules, we just have 3 mutual funds: the S&P 500 index fund, the emerging markets fund, and the inverse S&P 500 index fund. Every month, rank the 3 funds, sell the bottom 25% of your portfolio, and buy the top fund. So here's what the MRI looks like this month. Last month data, this month data. S&P 500 index went up 2%, the emerging markets went up 5.3%, and the inverse fund went down 2%. So you can see graphically that, remember last month we were relatively flat, while the markets continue to be relatively flat for around 10 calendar days. Then the markets started to take off. So according to current MRI model, if you remember last month we were 100% in the emerging markets. This month, since the emerging markets are still the winner, we are still 100% in the emerging markets. Now for Sector Surfer, who rotates these 3 funds using a different algorithm, it was in the S&P 500 index until July 31st. We just got a signal to switch to emerging markets. So yes, we got a signal to switch to emerging markets on the Sector Surfer system as well. So observations, the markets continue to be flat until July 10. Then the markets took off. Sector Surfer also signaled switch to emerging markets. Remember, Sector Surfer uses a different algorithm. Don't mix up the systems. And then, just because the 2 systems agree does not mean it's a sure thing. Remember, if the markets were to change within the near future, each system will have a different criteria to exit and switch. Just because you switch now doesn't mean you can become complacent. Keep watching your systems. Next system is the 25% trailing stop loss system. So for this one, if you really want to buy a stock, limit risk to just 1% of your total portfolio or trading account. Buy up to 4% of your trade account with that stock. Immediately enter a 25% trailing stop loss order. When the stock goes up 33%, buy another block of stock using another 4% of your account, and then update your trailing stop loss order to reflect the increased number of shares. Repeat until stopped out. And then, of course, the next system, if you're using Sector Server, which is a completely different system, remember, you have your own Sector Server system. I can't tell you whether or not your system has triggered a trade or not. However, we can at least describe Sector Server. It has two main tools. Like the 20-month moving average system, it has StormGuard armor to differentiate between when it's relatively safe or dangerous to be in the markets. And like MRI, it's a sector rotator, so it has both a bull market set of funds and a bear market set of funds. So when bull markets are signaled by StormGuard armor, we use one of the bull market stocks. When it's a bear market signaled by StormGuard armor, we use one of the bear market stocks. This is one way we can combine both systems to make it more robust. We've back-tested this. We found some weak spots that are easy to mitigate with appropriate design. And just remember other nuances when constructing or executing strategies. So Sector Server, if set up properly, you will get a signal through email or text. But I like to log on periodically. In other words, maybe once a week, just to make sure I don't have any signals pending. And for purpose of this video, I'm following the free strategy that they give you when you first sign up. So this free strategy remained in the worldwide fund. There are better strategies. It's very easy to design better strategies. There are instructions on Sector Server on how to design better strategies, but at least this one's free. If you like this one, we're still in the worldwide fund. So in summary, remember, we went over several different systems. They all have different rules. Don't mix up the rules. The possible exception is that Sector Server is built with two different rule sets, combining both StormGuard armor and sector rotation. You can combine as long as you at least backtest to see if it's worked before on your particular universe of stocks or mutual funds. We went over the 20-month moving average system, the MRI system, how to deal with stock tips, and reminded you to monitor your own Sector Server strategies. So keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Drop me a line, give me a call, email me to set up a consult. In fact, I've even set up an easier way to set up a consult. Just click on this link, calldavidye.com, and we can just schedule in whichever slot works for you. A few of you I've talked to, you know your stuff, you're fine, I don't have to worry about you. But for some of you, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.